In today's video, we shall analyze a very important concept, and this concept is investment in stocks. Actually, investment in stock is a very important concept nowadays because most of the retail investors are invested in stocks, and more and more retail investors are jumping into this bandwagon of investing in stocks. So it becomes imperative that people who would like to invest in stock should know how to do a simple equity research. It may not be possible to do a detailed research, but as a layman, we should know how to carry out at least intermediate level research about a stock before investing in a stock. So we shall try to analyze what are the components of this equity research. So, what should be our learning objectives for this simple concept of equity research? See, one is we should know how good is equity as an investment. And secondly, what are the risks involved in equity investment? How to do research and select a stock. There are various methods of research. We shall discuss each one of them. It is exhaustive to some extent, but in case if you want further analysis of that, you should go into detail of that. And we should understand what is fundamental analysis and technical analysis. Now coming to equity as an investment. See, equity investment actually represents residual ownership in a company. What does it mean, residual ownership in a company? See, when you invest in equity, means if you buy a stock, the ownership of the firm is guaranteed when you buy a stock. However, whenever a company is in dire straits, it means company is getting bankrupt or it is not running well, then there are a lot of investors other than the equity investors. Like banks have given loan, the company may have raised money through bonds, and many other methods of raising funds by the company are there. I am only giving one or two examples. In such cases, the assets of the company which will be sold at any particular point of time, the preference will go to the persons who have taken bonds, that is from the company. If the company has issued bonds, the right of the share in the sale of the assets in case of the delinquishment of the company will be with the bondholders, and then will be with the banks, and whatever is left out in that, those money will only come to the equity investor. So in the hierarchy of the right over the assets which will be sold, the equity investor come lower in the profile. However, equity investors have other advantages over the bondholders and the banks, because when we considered equity as an investment and ownership in a company, then whatever the profits made by the company can vary over a period of time. So equity owners are they have the right over the profits. We may call it as dividends, we may call it as bonus shares, or whatever it is. So they have the first right over the profit. So because bondholder will only get a fixed interest rate. Similarly, banks may have lent to the company with a fixed interest rate, so they will only get fixed amount of benefits, whereas equity investor, in case if the company is doing extremely well, will get hugely benefited. See, they have the ultimate claim over the function of the company. We should understand that they have the claim over the function of the company. It means since they are the owners, they can change the management. They have the power to change the management through voting rights. So equity holders will have voting rights, which will enable them to change the management if required. Equity investors, as I just explained, they get rewarded through dividend and appreciation in share price and bonus shares. What do you mean by appreciation in share price? Let us take example of the Infosys 20 years back, the face value of the shares may be 1 rupee or 10 rupee. Today it is trading at almost 1400 rupees. So the anybody who has invested 10 rupees, now they are getting 1000 rupees. That is almost 100 times profit. But the bondholders or the bank who have given, they would have got only the fixed amount of rate of interest, and whenever that commitment is finished, they will not get any further benefits from the company in terms of dividends and appreciation in share price. See, capital markets benefit investors who follow time diversification. What do you mean by time diversification? It means if capital markets always fluctuate. So the fluctuation will help investor to buy and sell the stocks. When the stock price go high, they can sell, and when the stock price comes down, when they can re-enter the stock. So this capital market give an opportunity to the equity investor to follow these things. However, time diversification helps. Suppose if a person is invested in a very good stock, so whenever the stock price comes down, he can re-enter the stock. So over a period of time, if the equity investor hold the stock for 5 years or 10 years, a longer time horizon, he will have better appreciation in his rewards which he get from the company. Equity investment can be done in listed securities. See, what are listed securities? Securities are listed in the stock exchange. It can be Bombay Stock Exchange, it can be National Stock Exchange, it can be commodity exchange, anything. Okay, what are the characteristics of listed security? Listed securities are liquid. It means since it is traded in a stock exchange, a lot of people buy and sell shares. So it will be easier for a person to re-enter and exit the market whenever he wants. However, equity market is affected by the market sentiment. There is something known as the market risk. Market risk is you cannot hedge market risk, because market moves due to various factors which we may not expect. Political factor, world factors due to any of the variation in the world market. So all these factors will affect the equity market. Hence, it gets affected by sentiments whenever a security is listed, and they have to follow stock market rules. The rules set by the SEBI and these rules set by the National Stock Exchange has to be strictly followed by these companies if they want to get listed. So these are the advantages of and characteristics of listed security. Now coming to unlisted securities. See, unlisted securities are illiquid. It means you cannot buy and sell whenever you want, because it is not traded in any of the stock exchanges. Secondly, the benefit is it does not get affected by market sentiments. At the same time, it will not be easily available, and it does not follow any stock market rules. So the company has to follow certain market rules if they have to get listed. So it is always better to invest in listed securities rather than in unlisted securities until and unless you are very sure about the product the company is producing, and at the same time the company management. Now coming to the types of equity shares. See, there are normal equity shares where you have a person will have a residual ownership, and there is something called as preference shares. See, preference shares rank above the normal equity shares with respect to dividends and distribution of asset in case of liquidation of the company. So the hierarchy is higher for preference share, but preference shares do not get voting rights. So preference share cannot take part in the function of the company since they do not have the voting rights. Preference shares can be perpetual. It means till the time the company exists, you can keep holding the preference shares, and you can accumulate the preference shares also. These preference shares can be participating or non-participating. See, participating and non-participating means non-participating preferential shares get a fixed dividend, 10%, 5%, 8%, whatever is that. Even if the company makes 20% profit, they will get only 8% dividend. But participating preference shares, they will get the dividend as per the normal equity shares. You can convert preference shares also into normal equity shares, and sometimes preference shares can also be converted to debentures if required, and vice versa. Some companies can also issue preference shares with differential voting rights. So differential voting rights, it's a very long topic. We will not go. They may have voting rights with a limit, with reservations and limitations. That's all. Now let us understand what are the risks involved in equity market. So before investing in equity market, you should be aware what are the risks associated with the equity market. The first and the foremost component is the market risk. See, this market risk cannot be diversified. Market risk occur due to fluctuation in prices of stock due to various factors. The factors can be politics, the factors can be government policy, the factors can be announcement of any new government policy. The factor may be some instability in the world politics or in the world, like Ukraine war, which recently happened. Any decisions taken by the oil countries. So these are all the various factors which may affect the market. So this is market risk. It is not possible to diversify the market risk. See, market risk is also called as beta in market parlance. Market risk is independent of business sectors. So you can be in any sector: banking sector, auto sector, pharma sector, FMCG sector. It is independent of any business sectors. So market risk affect each and every sector. See, market risk, you can hedge a market risk, but you cannot diversify a market risk. Since it affects all the sectors, you cannot diversify the market risk, but you can always hedge the market risk by using various equity market instruments like futures and options. Now coming to sector specific risk. It is a non-market risk. It means to say it will be specific to a particular sector. Sector specific risks can be easily diversified just by avoiding that particular sector if it is not doing well. Now company specific risk. It is again a non-market risk, and it depends on the product of the company, the performance of the management, and the ability of the management to run the company efficiently, and the productivity of the employees. See, these days transactional risk is generally nil, because most of the markets are transactions of the equity market is done to electronic stock exchange, and there is very less chance of default. So transactional risk is the risk of counterparty not fulfilling the obligation of paying the money or delivering the shares. So that is not possible in today's world, because we have an electronic stock exchange, and then there is margin money which is required to be given by the counterparties, and the shares to be pledged. So this transactional risk has been greatly reduced in the present scenario. Now coming the liquidity risk. Liquidity risk means the risk of not able to buy or sell shares due to non-availability of buyer or seller. Liquidity risk mainly happens in the unlisted security, which we have just discussed. Listed securities are generally liquid, but if you have invested strongly in penny stocks or illiquid stocks, then you will not be able to sell those stocks when the market crashes, or you will not be able to buy those stocks when the market is in a very heavy bull market. So this is called as the liquidity risk. See, liquidity risk can be mitigated by only buying large and mid cap stocks, which generally has high liquidity, and avoiding penny stocks. See, there is something known as impact cost. The liquidity risk is measured by the impact cost. What is impact cost? Impact cost is nothing but the price movement achieved when a very large deal happens, and the difference between the best offer and the bid price is the impact cost. So higher is the impact cost, more will be the price movement due to a very large deal, as a result of which illiquid stocks will have very high impact cost. So how to mitigate risk in equity investment? Very simple, through diversification. So there are two types of diversification. One is time diversification, and another is sector specific diversification. You can invest in different sectors. And the time diversification is generally done, very famous, everybody knows about it, systematic investment plan over a longer period of time. So equity market, generally we have to have a horizon of 5 to 10 years if you have to get a decent return in the equity market. See, before undertaking diversification, it is important, especially time diversification, it is important to understand the business cycles of various sectors. See, business cycles, we will be explaining it next. See, every country undergoes a business cycle. There will be a economic cycle. The country undergoes economic cycle, and based in the economic cycle, various sectors perform well in one cycle, one cycle of the economic cycle, and another part of the economic cycle some companies work. For example, in a bull market, usually growth stocks like auto, banking do well. But whereas in case of a recession, defensive stocks like IT and pharma stocks, FMCG stocks, they do well. So that's what the next point is, there are basically growth stocks and defensive stocks. So growth stock perform well when macroeconomics are good, and defensive stocks perform well when the economy is in recession. Now let us understand now how to do equity research and what are the methods of equity research. The first method is the fundamental analysis. See, fundamental analysis is a very, very big concept. And lot of efforts, and big companies like JP Morgans and others do lot of research on each and every company before investing in those company. So a fundamental analysis usually involves economic analysis, industry analysis, and company analysis. See, what does fundamental analysis do? It tries to determine the intrinsic value of a company by analyzing the cash flow of the company, interest rates in the economy, and future earnings and risk variables. What are the future earning capability of the company and the sector as a whole, and what are the risks involved? Basically, it is called as SWOT analysis, that is strength, weakness, opportunities, and threat analysis. See, if the market price is lower than the intrinsic value, then we can buy the stock after considering the transaction cost. See, there are two methods of fundamental analysis. The first one is the top-down approach. A simple concept, nothing great. In top-down approach, we do what is known as EIC approach. First, we carry out the analysis of the economic cycle, in which part of the economic cycle we are in. And secondly, based on that, we select the sector / industry which are in synchronization with the economic cycle. So if the economy is going up, then what are the sectors which are in sync with that, or any sector which has got more beta compared to the economic cycle will be selected, that is growth stocks. Then select the company which is a market leader in that particular sector. Let us take an example. Suppose if the economy, if we are in the low interest rate scenario, usually white goods like auto and electronics will do very well. So we have to select those sectors. Once you select those sectors, you just cannot invest in any of the company. You try and select the company which is a market leader and then invest in that particular company. So this method is called as EIC approach. What is bottom up approach? We follow just the opposite. We select a company and see whether the sector which we are in the company is in a sync with the economic cycle, and then we invest in that particular stock. There is something called as buy side research. It is done by analysts for mutual funds, hedge funds, pension funds, or portfolio manager. They generally generate reports of the company and provide buy or sell recommendation. Now, sell side research is done by the investment banking, broking, advisory flight. See, investment banking, broking, and advisory for clients are basically for short term trading, whereas buy side research for mutual funds, hedge fund is basically they for longer time horizon. Pension funds, they all look for long time horizon. Now, coming to economic analysis. See, a number of economic activities are affected by a number of factors. Like monetary and fiscal policy affects economic activity of a nation. Macroeconomic factors that influence economic analysis are GDP of a country, interest rates, inflation rates, unemployment rate, wholesale price index. Wholesale price index is directly related to your inflation, and index of industrial production. See, the analyze the effect of these components on various sectors and then select a particular sector for further analysis. What is industry analysis? See, industry analysis based on the economic analysis. Some industry does well during high inflation, called as defensive sectors, and some industry does well in recovery phase, called as low interest rate, called as growth sectors, as the cost of capital during the low interest rate scenario will be less. And finally, company analysis is basically what is the product produced by the company, how good is the product, and what is the market available for that product, and who are the competitors for those product, and how good is the management. So finally, how good is the financials of the company is also very important. See, many companies follow offensive or defensive strategy to counter these threats after conducting the SWOT analysis. And finally, what is the business model of the company? See, some company follow cost leadership. Cost leadership means they will try to manufacture components, high quality components, and try to sell them at lower cost compared to their competitors. Or secondly, differentiation model. Some companies may produce products which are slightly costlier, but the quality and the service provided them are extremely good compared to other company products. We can take the example of iPhone has got a fantastic ecosystem. That's why their products are costlier, but still people buy it. That is called as differentiation. See, analysis of the companies are done based on different sectors. Suppose if we consider telecom sectors, they do based on the average revenue per user. And if you take banking sector, they are dependent upon net interest income. And footfalls and store sales are basically for retail sectors. And there are so many other components depending upon the type of industry which you want to do the research. So now let us analyze all these analyses, that is macroeconomic scenario, industry scenario, and company scenario in detail, one by one. Now coming to macroeconomic analysis. See, any earning potential of a company is determined by the prospect of the industry to which it belongs. This in turn depends upon the economic condition of the country and also the economic condition of the world. See, economic condition of a country is dependent upon the economic conditions in the world. For example, when we had Ukraine war, even though our economy was very good, all the basics were right, but still there was a market crash due to when the Ukraine war started. Similarly, when the Israel war started also, there was a slight dip in the market. So generally market tend to react to any of the events in the world. So the stock price changes can be affected due to the following factors, which is the basis for the economic analysis. See, economy related factors contribute to 25 to 30% of the price fluctuations of a stock, and industry related factors contribute 50 to 20% in the price fluctuation, and company related factor is the major one, which contributes about 30 to 35% in the stock price of a company. There will be other factors which intangibles which you cannot understand, and nobody can understand. So those component contributes about 50 to 20%. The very important example of other factor is corona. So nobody expected corona going to be such a big epidemic. So these are the other factors. Okay. Now coming to the global economy. See, some economy. See, none of the countries are decoupled from the world market. We do exports with other countries, and we want to import raw materials, finished products, semi-finished products from the other country. So, the economics and events, political or otherwise, will have an impact on the economy of the country with which we are doing business. So we are always linked with the other countries' economic performance. See, the global economy will have an impact of export prospect of a firm. Similarly, competition from foreign firm is also a factor which we have to consider when we are doing a macroeconomic analysis. See, time to time economic turmoil in a country can happen due to political and other factors, and this may affect the performance of a company, that I have already explained. Similarly, when we do business with other countries, each country will have a different currency. So there will be a currency fluctuation in world market, and the exchange rates between the two trading partners will have a direct impact on the earnings of a company. So an Indian company dealing with US or Europe, so any economic turmoil, or if the US dollar gets hardened with respect to the Indian rupee, then it will have a direct impact on the cost of the raw materials also, and at the same time the profits related to our imports and exports also. Now coming to the fiscal policy. See, when we come to the policies of the government, we have something known as the fiscal policies. See, fiscal policy is basically tax related measure. Um, See, any increase in tax will dampen the economy. Government spending related measures like government spending on infrastructure and other activities boost the economy. So fiscal policy basically deals with the money related events. So the fiscal policy of a government basically involves in setting up the tax rates, and at the same time investing in the infrastructure of an economy. So basically fiscal policy will have a direct and immediate effect on the economy. Now coming to the monetary policy. See, monetary policy is nothing but the control of money supply in the market. Monetary policy is generally done by the Reserve Bank of India as far as India is concerned. See, monetary policy is done through various measures by RBI, through interest rate decisions and open market operations, buying and see, what is open market operation? Open market operation is nothing but buying and selling of the bonds by the Reserve Bank of India. See, if you are interested in detail about the fiscal and monetary policy, I have made a separate video on the entire functioning of the Reserve Bank of India and what are the open market operations carried out by the RBI. I will put a link in the description. You can go and check that particular video. So this will be central government policy, and it will have a delayed effect on the economy. See, usually monetary policy measures will take some time to impact the economy of a country. So it will have a delayed effect on the economy. Now coming to the GDP growth rate. See, GDP growth rate is an important indicator of the development of any industry or economy in a country. See, GDP, what is GDP? See, GDP in short is the total production of goods and services in an economy during a specified period. See, GDP is always calculated for a particular period, for 1 year, for 5 years, year on year GDP growth. So all this has to be taken into consideration. Now, the growth rate of the GDP is an important indicator of the growth of the economy of a country. So now, GDP does not include the black market transaction and the unpaid work. See, black market transaction we all know. So what is unpaid work? See, any work done by any person for himself and his family which will not get paid back is an unpaid work. There are a lot of such events happening in the economy. We will not go into the detail of unpaid work and all. So I have just given an example what is an unpaid work is. So that will not get included in the counting the GDP. So what we have explained is GDP is the total production of goods and services in an economy. Goods means all industrial goods like auto, car, white goods like electronics and others. And services, we know all IT services, logistic services. These all come under services. Okay. Now, GDP measurement has different approaches. So one is known as the production approach. So what is production approach? Here, the value added at each stage of production is considered. It means, suppose if you are manufacturing, a company is manufacturing a car, and the company has got subcontracts where it is getting tires, where it is getting axle. So at every stage of the production, whatever the value addition is done, that will only be considered. So that is known as the production approach. So it is the total sales less the cost of intermediate inputs. So whatever the total sales of that particular company less whatever the goods cost of goods which is included and in the intermediate inputs, that is reduced, and that is known as the production approach. Now the second one is known as the income approach. Here in income approach, what happens is, here the income earned by all the productive people of a country is measured plus the earning surplus of the company. What does it mean? In income approach, every person will get paid for the work he has done. So the income earned by all the productive people of a country, that is added, plus when the company gives salaries and other things, the profit generated by the company may retain certain surplus money which is still left after all their commitments are done. So that is known as earning surplus. So that earning surplus will also be added in order to calculate the GDP. Now the last method is the expenditure approach. So what is expenditure approach? In expenditure approach, whatever the total purchases made by the buyers will be considered, and that will be calculated for the purpose of GDP. So the GDP that is calculated is called as nominal GDP. So what is the difference between a nominal GDP and a real GDP? Nominal GDP does not consider the effect of inflation. So if we have to deduct the effect of the inflation year on year, in that case the GDP which is reduced by the inflation is known as the real GDP. So what are the factors which affect GDP? See, structural changes in the government policy is the major cause for changing the GDP or affecting the GDP year on year. If increased investment is done through the foreign direct investment, then it will have a direct impact on the GDP growth. Increased productivity of the country, better management policies, and increasing use of technology will have an impact on the GDP. So these are all very clearly understandable things. I am not going to give any explanation to that. So if any investment by the foreign countries or the foreign direct investment will ensure more industries are developed and more capital intensive industry come into existence. And increased productivity means a person who is producing more with the same amount of time is known as productivity. And finally, we have something called as better management policy and increased use of technology. Now coming to the GDP growth rate calculation. How to calculate the GDP growth rate, which I have explained. See, in order to calculate GDP, three important sectors are considered. They are agriculture sector, industry and services. See, the growth of these sectors are calculated based on the weighted arithmetic average of these over a period of time. So the growth rate of these sectors are calculated and weighted arithmetic average of these are considered as GDP growth rate. What is weighted arithmetic average? Suppose if agriculture has got 30% weightage and industry has 40% weightage and services has 30% weightage, then if the growth rate of agriculture is 15%, so then we multiply 15% with 0.3. Similarly, and add industry has got 10% growth rate, then we multiply 10% growth rate with 40% weightage. And similarly, services has got 30% weightage. If the services growth rate is 20%, then we multiply 20% with the weightage of 30% to get a consolidated GDP growth rate for the economy. Now coming to the industrial growth rate. See, industrial growth rate is considered through the index of industrial production. We shall not go into the detail how index of industrial production is calculated, but we'll just touch upon it. See, this is published every month and it has got a very short time lag of just 42 days. See, although production has got only 15% share in the GDP, but it is the most volatile one because of the any changes in the economic policies. It will have direct impact on industrial output, and this in turn will have an impact on the industrial growth rate. Since this is very volatile, so it becomes an important component of the GDP. Now coming to agriculture and monsoon. See, this will have an indirect impact on the economy. How? We shall see. See, agriculture has got 25% weightage in the GDP forecast. As we know, a very good monsoon will have a direct impact on the agricultural production. So this in turn will have an impact on most of the industries which are dependent upon the agricultural as its input. For example, we can take FMCG. Now, more money in the hands of the farmers will also come if there is a good monsoon. Good monsoon means good harvest. Good harvest means farmers will get more money in their hands, and this will make farmers to spend more. So that is how the economy works. Now coming to savings and investment. This is one of the component which affect the GDP growth rate, and GDP growth rate in turn will affect your economic analysis. Okay. These are all related. That is why we are explaining how macroeconomic analysis is done. So these are all the components of the macroeconomic analysis. Now, corporate and government require money for spending and running an industry. See, government require money for infrastructure spending, and corporate require money for establishing new industries or increasing capacities in the present setup. So this money supply has to come mainly from the savings of the retail or public. Whatever the savings which we put in the banks, that is the money basically and primarily used by the companies and by the government. How do the government get money? Government issue bonds. So they are called as gilt bonds or treasury bonds. So they issue bonds at a predetermined interest rate which we buy because usually government bond interest rates are higher than the savings interest rate given by the bank. So usually high net worth individuals usually invest in government treasury bills. Okay. Now coming to the corporate also issue bonds, or corporate may also issue IPO, that is initial public offer, or follow on public offer, which the retailers buy. So what is the how the money comes to the corporate? Corporate may generate money through initial public offer, follow on public offer, or by giving corporate bonds. Similarly, government will generate money by having a method of issuing bonds called as treasury bills. Okay. Now demand for corporate bonds come only if the savings are high in the economy. This is a common sense. Generally, investment in economy is equal to domestic savings plus the foreign institutional investment minus the whatever investment made by the retailers or the high net worth individuals abroad. So this is a general equation. What is the total amount of money which may be available to the government and for the corporate to utilize for their spending? That is through domestic savings. You add foreign institutional investment in the India, and you reduce the whatever investment made by high net worth individuals outside India. Now coming to government budget and government deficit. See, government generate majority of its revenues through indirect taxes. What are those indirect taxes? GST, excise duty, custom duty, and they have very minimal income through income tax. So, majority of expenditure of the government is revenue expenditure. What is revenue expenditure? Revenue expenditure are non-capital expenditures like salaries, subsidies, and expenditure on defense. So the difference between the income generated by the government and the expenditure of the government is called as fiscal deficit or fiscal surplus. If income is more than expenditure, it becomes a fiscal surplus. If the expenditure is more than income, it becomes a fiscal deficit. Another form of deficit is the revenue deficit. What are the revenue receipts? We have taxes, interest income, etc. Whereas revenue expenditures are salaries and subsidies. So, whenever the salary expenditure becomes higher than the revenue receipt, that is, revenue expenditure become higher than the revenue receipt, then it also have a deficit called as the revenue deficit. So, fiscal deficit has to be financed through the government borrowings. How does the government borrow? The government borrow money from the RBI. But if the government start buying money from the RBI, it will generally increase the inflation. We will not going deep into the how this money supply. This is basically a money supply concept. So it is a very important concept. I have explained it in a different video. I put a link in the description. You can see it. How money supply is managed by the Reserve Bank of India. So, and secondly, government gets money from domestic capital market, and finally from abroad. Abroad means for foreign portfolio investors and foreign institutional investor may also invest in many of the government borrowings meant for infrastructure spending. Now coming to the government debt. See, government debt should not be more than 60% of its GDP. Okay. Now, this money supply comes mainly from the savings of the retail or public. Now let us understand what is a money supply. There are two types of money supply. One is M1. See, M1 money is the cash held with public plus the demand deposits. Again, demand deposit is a very huge concept. Demand deposit in short means any savings and very short term deposit of 1 year or less, like FD and other, kept by the retail retail savings accounts is known as demand deposits. So if I have kept FD for less than 1 year or 1 year, and my savings account also has got some money, they are called as demand deposits because this money can be demanded by the depositors anytime from the bank. So that is called as demand deposits. And other deposits with banks. Sir, there are other deposits also other than the demand deposits which form part of the M1 monies. Now what is M3 money supply? Now M3 is M1 plus time deposits with bank. Time deposits are nothing but any deposits which are held with bank with a time horizon of 1 year or more. Like some FD may have kept for 5 years, some FD may be there for 7 years. There are some time deposits which are 10-year time deposits may also be there. So they are all called as time deposits with banks. So what is the concept? Growth in M3, that is this M3 money, can happen due to three factors. It can happen only if there is a growth in the economy, means growth in industry. Growth in industry and economy means all the three has to click. That is, there should be a good monsoon, your industry output should be high, and services output should also be high. So if all these three factors does well, then only economy grow. And secondly, financial deepening of the economy. See, financial deepening of the economy means more fiscal prudence in spending. That is called as financial deepening. Now, monetization of deficit by deficit financing. See, deficit financing is another important concept wherein if the government has to borrow money to fulfill its fiscal deficit, then they will go for borrowing. But how do they do it? They do it by issue of bonds to RBI. So RBI will buy those bonds. Now, uh, first of all, if we consider, let us go get into the first concept known as inflation. See, inflation has mixed impact on the industry. A moderate inflation is good for the economy, whereas a very high level of inflation will reduce the money supply in the market. Interest rate, a lower interest rate is good for certain sectors, whereas higher interest rate is good for some other sectors. However, lower interest rate is always good for a economy to grow well, because it put more money in the hands of the people to spend. Now coming to the balance of payments. See, balance of payment is nothing but balance of current account plus balance in the capital account. What are current account? Current account means merchandise trade plus invisibles. Merchandise trade is nothing but export and import of goods outside India. And secondly, invisible is like remittances outside India, travel expenditure, software purchases, interest and dividend payments. They to the foreign portfolio investors or foreign institutional investor who are invested in India, you need to pay them dividends also, and you may have to pay interest also if some of the foreign institutions have purchased either the government bonds or the corporate bonds. So that is also form part of the expenditures called invisibles. Now coming to the capital account. See, capital account is nothing but external borrowings, repayment of external borrowings, disinvestment and investments. The difference between the current account and the capital account is the trade balance. See, balance of payment deficit, it means if the imports are more than exports, then it depletes the foreign exchange reserves and it will have a direct impact on the exchange rates. uh, if we have to deal in detail with the balance of payment, we will generally explain that whatever we import from the foreign countries or the other economies should be less than what we export. If that is there, then we have a balance of payment surplus. But if our imports is more than exports, then the balance of payment deficit arises. There are various other factors also which come into play, like exchange rates, which will have a direct impact on the balance of payment deficit or surplus. So this is a separate chapter itself for for forex reserves and exchange rates. We will not go in depth into that. So what we can generally say is balance of payments will have a direct impact on the economy. If our forex reserves are very good, then our exchange rates will be very good. If our exchange rates are competitive, then our exports and imports will have a very good market. That's what we can consider at present. Now coming to the exchange rate. See, fluctuation in exchange rate will have a direct impact on industries dependent on exports or import of raw material. See, it is a double-edged weapon. For some software industries like IT, any depreciation in your rupee will have a positive for IT industry, whereas that is not the case for some industries where they are importing raw material. So we should take this exchange rate concept in a slightly with a pinch of salt. So India has a floating rate policy on exchange rate. It means India usually leave the exchange rate to be managed by the import export differences only. They do not manipulate the exchange rates, but they will interfere only when there is too much volatility in the exchange rate, because too much volatility in the exchange rates will have a very very bad impact on the Indian industries which are export oriented. Okay, so RBI intervenes only when there is a very high volatility in exchange rates. So how does the RBI do this intervention? First of all, they change the interest rates itself or the exchange rate itself. And secondly, they will change the exchange regulations. And finally, they will buy or sell foreign currency in order to maintain the exchange rates. Now, coming to foreign investment. See, foreign institutional investor is the main source of investment, where they invest in projects, and hence it is a long term investment. Whereas foreign portfolio investment is investment in equity market. See, India is coupled to our market mainly due to its dependence on foreign portfolio investor for risk capital. Risk capital means investment in the equity market. So very high FPI inflow can lead to liquidity bubble in the stock market, because foreign portfolio investor, if they invest in one particular stock, so that stock can get boosted in such a way that its intrinsic value, the market value may be very high compared to the intrinsic value, which will eventually bring down the market price. So that is called as a stock market bubble. India is dependent upon the foreign portfolio investment due to its current account deficit. That is, imports are more than export, as I have explained. So since India has inherently has a current account deficit, so we have to be dependent on foreign portfolio investment in the stock market for risk capital. See, equity portfolio inflows has a very strong impact on the exchange rates. Now coming to the infrastructure facilities. So whenever any foreign company wants to invest in a particular state or in a particular country, they expect certain facilities to be established. That is a good infrastructure. Infrastructure includes sufficient amount of power supply, and a very robust transport network, and assured supply of raw materials like steel, coal, oil and gas. And the most important is how good is the government policy for foreign institutional investor to invest, or foreign companies to come and establish their factories in India. The government policy should basically focus on providing good support for fixed assets and for the working capital. Now coming to industry analysis, what we shall do is we shall take industry analysis in a different video, because industry analysis and financial statement analysis will be the next two important concepts we will discuss in the next video. And in the final video we will discuss the financial ratios and what are the advantages and disadvantages of the financial statement analysis. Okay, thank you.